Are you investing in the SCHD? If you're like me, I hold it as a part of my portfolio, but should I be holding it? Should we sell out of the SCHD? Now, the article over on Seeking Alpha really breaks it down, the reason why you should pull out of the SCHD and no longer invest into this ETF. Now, when we start looking at the last year, fully and really does highlight why people shouldn't own the SCHD, because it is consistently underperforming that S&P 500, which during the market pullback, which we're seeing right now, the SCHD should be outperforming by a big margin, but it's struggling to catch up because of the underperforming for an extended amount of time in relationship to the S&P 500. So when we break down the exact logic and why are we seeing this, it is because the SCHD is focusing on a sole thing, which is dividend growth within the company, not focusing on finding the value and finding the dividend growth at a value add, meaning that they are buying companies that have a strong dividend growth, even though the companies might be severely overvalued. Now, this leads to a higher P/E ratio, nearly 18x with a massive cap of 140 billion. If you're unfamiliar with this ETF, it is one of the largest and one of the biggest ones that people do invest in. When we look at what they hold in their top 10 stocks, this is where, again, it kind of is interesting because of the large valuation. So when we think of the biopharma stocks that they have, Abrive is one of the largest funds, trading at 14x the 2026 EPS targets, and really a bargain compared to everything else that we're going to look at when we're starting to break these down. Now, the primary function or the primary issue that they see with the SCHD is it isn't buying cheap stocks as it's picking its selections. It is buying it based, again, on that dividend growth. When we start looking at Verizon Communications, which is near the top 5 position that we see within there, recent warnings due to a large dividend increase, recent stock gains, and the wireless company continues to hike dividends. That is the reason why it is held in the SCHD, is that dividend hike. However, Verizon has been posting very weak results, and really the example of why they're building the dividend growth in the concept of the company doesn't work when the company isn't making money and they are not profitable. Now, when we look at the wireless giant, strong dividend gains, but the stock has a 5-year total return of 12%. Think about that. So even though it's pretty good on the dividend side, the total return is 12% in relationship to that same time frame where the S&P 500 put up a 165% return in the last 5 years versus a 12% that we're seeing in Verizon. So instead of growing that stock and fixing up the portfolio, they are giving it back in dividends. Verizon has raised the dividends for the last 18 years, yet the debt levels are skyrocketing. The gains on the stock itself are not there at all, meaning that they have actually downgraded the company, even though it is paying more in dividends. Now, the SCHD had sold out of Broadcom. If you remember the reconstitution back last year, stock traded around 135, soared to 250 because of the AI infrastructure, meaning this would have been a massive gain for the SCHD, being able to outperform that S&P 500. Broadcom doesn't have a very high dividend rate. That is the reason why it was cut 0.06 or 6 cents per quarter for 11% growth. Tech company only has a dividend yield of 1.2, which of course was the reason why they sold out of it. So even though the dividend yield was a little bit lower, the growth factor of Broadcom has been really big. Again, these are examples that they're covering where the dividend growth concept doesn't make a best stock selection. So you might not be in the best position short of having that dividend growth. When we start looking at some of the bigger companies like Coca-Cola at the 3rd largest position in the SCHD, really the structural problems. It has underperformed the market for an extended amount of time, even though they're paying a lot higher dividend in Coca-Cola, and very consistently, we're not seeing the growth. And even this year for Coca-Cola, they're expecting a 2 to 3% growth, which means even though they're paying out the dividend, when you look at the overall performance of the SCHD and the growth aspect, it is not going to be and really shouldn't be another year where we see not only good dividends, but we see good growth. Now, Coca-Cola has long underperformed the market and really the willingness of investors to hold on to it from the safety perspective of the interest or the dividends that they're getting out of here. Same can be said when you look at PepsiCo, when you look at Home Depot, very aggressively priced. They are very some people say overvalued, but they do pay those regular dividends, but we're not going to be seeing the growth out of it. Now, when we look at the looming disappointment, and this is the final point that they do make, the fund naturally points to our goal of mirroring the performance of the Dow Jones US Dividend 100 Index. SCHD looks good compared to other funds, unless you compare it to the SCHD, or excuse me, the S&P 500. Now, the SCHD considerably and constantly fails to beat that S&P 500, even though all 10 of the top stocks, which are 40% of the portfolio, $77 billion, are members of the S&P 500. They are the dividend paying and not the growth stocks that we're seeing out of there. Now, investors can make a case for investing in the dividend growth as a diversification method within the portfolio versus just buying the index itself. But when you start looking, it doesn't make sense, because if you're investing for the growth and then essentially switched it at a later date to the SCHD for the dividend income, it would really make a big difference. Now, if the SCHD would increase the level or really have a little bit of stronger performance in the market versus just going for the dividend yield, we could see it. Even thinking where the market is down right now, over the last 6 months, the S&P 500, even with a massive pullback, is still outperforming the SCHD over the last 6 months, even with the total return that we're seeing of the dividend yield of that 3.6%, still not outperforming the S&P 500. So final note, or the takeaway, key investors takeaway, really looking at the recent market pullback that we're seeing, instead of just buying the benchmark, holding onto that SCHD. And a lot of people are saying SCHD is worth holding through the current market weakness that we're seeing. After it, you should flip it to another dividend growth ETF, or possibly just buy the index itself with the yield that we're seeing out of the index, as well as the growth factor that we're seeing out of that S&P 500, really poising yourself in a lot better perspective. Now, me personally, when I read things like this, and this is the reason why I wanted to cover it, I know the SCHD has been underperforming for a couple of years. And the reason that I really feel is because when we start looking bigger picture at the performance of the SCHD in relationship to the S&P 500 and the growth that we have seen out of the tech sector and the growth that we have seen with the artificial intelligence stocks, have just been unprecedented. There was no way for investors to know, buying NVIDIA, buying some of these really big AI, these really big tech companies, we're just going to skyrocket with quantum computing, AI, and everything else that is coming out. We didn't know at the point. Again, I know a lot of people were invested in it, kind of see it coming, but me personally, holding on to the SCHD as a small part of my portfolio, in my opinion, does kind of make sense, because I have a lot that is in that big growth factor that is in the NASDAQ 100, have a big chunk that is in the VOO when we look at the 3 ETF portfolio. And the last portion isn't the SCHD just as a generation. But the question is, does the SCHD make sense in relationship to some of the other ETFs that are out there, like the VYM and some of the other dividend ETFs that are performing a little bit better based on performance and based on exactly what they're investing in. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about the SCHD and where do you think it's going, because it did also get a rating downgrade, meaning it did downgrade if it's a buy, if it's a sell, if it's a strong buy. It did get a downgrade. Unfortunately, it looks like it was a couple days ago that it received this downgrade. So again, let me know in the comments what you guys think. And as always, thank you guys for watching.